Welcome to our second Risk Parity Radio tutorial. This tutorial goes along with the podcast Risk Parity Radio. Now, what we will be looking at today is one of the calculators on Portfolio Visualizer. And you see the main page here, portfoliovisualizer.com. And the one we're going to be talking about today is this backtest portfolio one here. So we'll just click on that. Now, this is a tool that you can use to backtest individual funds in a portfolio or individual stocks with ticker symbols. And so we will just go ahead and show you how to do that. First thing I would do, though, is change this year to year thing to month, because you'll get more data. It will use the monthly data instead of annual data. And then as you can see, you have all of these options here. The earliest start year is 1985 for this data. Most of the funds don't go back that far, though. But we will be looking at some of these other features after we put in a portfolio. Now let's just take a simple portfolio, a 60-40 portfolio that you're probably familiar with. We'll do the VTSAX, Vanguard Total Stock Market. We'll do BND for the total bond market, and we'll make it a 60-40 portfolio. Okay, and then you just come down here and you hit Analyze Portfolio. And it gives you this nice little pie chart here. It shows you how the thing grew. But before you get to looking at this, one thing you should always look at is this little bar here, because it will tell you how the data is limited due to the limitations on how long your fund has been in existence. So here it gives us a suggestion as well that BND only goes back to May of 2007, but we can go back farther if we put in VBMFX. And so we'll just go ahead and do that right here. And we'll rerun this. And now we've got more data. This is going back to 2001. But let's look at that again, because VTSAX is limited. It only goes back to December of 2000. But we can use this earlier version of the fund, VTSMX, the oldest version, and put that in there. VTSMX. It's also the total stock market. And we'll rerun that again. And now you see we have data that goes all the way back to 1992. And so that's a lot longer time series. And you can see how this grew over time. If you look at this portfolio returns thing, we started with an initial balance of 10,000. That's by default. You can change that. It's got a final balance of 122. If you go over and mouse on this, it'll give you the inflation adjusted balance. So you can see what effect of inflation had on that over time. Same thing with compounded annual growth rate. That's the nominal compounded annual growth rate. And then if you click on there or mouse over there, you see that the inflation adjusted compounded annual growth rate was 6.38%. And you look at maximum drawdown. This Sharpe ratio is a risk-reward ratio that you want to be as high as possible, as is the Sortino ratio. The Sortino ratio only focuses on downsides. So you can also then look at the returns over years here, and there are a whole variety of ways of slicing and dicing this. So you can look at something called rolling returns by clicking on this. And you see what the high, average, and low was for that it did have 5-year periods where it was underwater. That's important to note. You click on the assets one, it looks at the assets in particular and what they did in your portfolio. This drawdowns one is very interesting because it shows us how far down it went, that there were really two bad periods for this, one in the early 2000s where it's down about 21% and or 22%, and then one here where it's down over 30%, and that's 2008, of course. And then here's, you can see the smaller one that is March of 2020. It doesn't go as far down as it did last March, actually, because it's only taking the monthly data, so it's end of the month data. All right, then you can look at things like monthly returns, go to annual returns, and then these metrics will give you a whole bunch of statistical analyses of your portfolio. So this portfolio, one of the more interesting ones besides the sharpened Sortino ratios, is it gives you safe withdrawal rates for this period. And you see it's relatively high because this portfolio did grow well in the 1990s and didn't have a period like the 1970s. And you'll find that in shorter time frames, most of these safe and perpetual withdrawal rates are on the high side, because we're not looking at a 50-year time series. But now let's go back up here and look at some of the other features that you can adjust and change here. You could change the initial amount. One thing that's interesting, you can change how it gets rebalanced. We're leaving it on rebalance annually, but you could change it to different rebalancing schedules, or you could do it on rebalancing bands, in which case you can put in actual numbers here to create rebalancing bands for this portfolio. And we'll go back to rebalance annually. You can also look at this portfolio in terms of actually drawing down on it, where you could contribute to it, but you could also withdraw from it, withdrawing a fixed amount. So that would be an inflation adjusted amount, because it says we have inflation adjusted, yes. And so this would be like the same kind of analysis you saw or you're familiar with from the 4% rule. This would be $400 a year inflation adjusted for this portfolio. And then if you run that analysis, it will run it for you. And give you a different look. This is as if you were taking out 4% a year. And you can see the drawdowns are a little bit different. The compounded annual growth rate is different. And the final balance is also different. Now, if you want to see what more aggressive drawdowns would look like, if we went to 6% inflation adjusted, you see it's barely holding up there. And only because it had such a good time in the 1990s when it grew from 10,000 to 20,000, and that's basically what sustained it after that. If you would have started sometime around here, it may be going negative by now. And you can also do this as a fixed percentage. What's going on here is this just looking at the percentage available at the beginning of the year, so it's not continually ratcheting it up. And we'll put in 5 for that just to look at that. And then click on it here. Okay, so that is the basic features of this analyzer. And you can put in just any portfolio that you can come up with. Now you will be limited by the amount of data for the particular ticker symbols, but you can see you can go back quite a ways with this. There is a different analyzer that doesn't use ticker symbols that we will talk about in a different tutorial that uses asset classes that goes back further. You should also use that when you're analyzing portfolios. But one of the more interesting things to do with this is to look at comparisons between portfolios. And so I set one up here in this next tab. And what we have here is this traditional 60-40 portfolio we've been looking at, stocks, total stock market, total bond market 60-40. And then we're comparing it to two other portfolios that are sample portfolios on our website. And so we have the Golden Butterfly. This one is 20% in a total stock market fund, 20% in small cap value, 20% in long-term treasury bonds, 20% in gold, and 20% in a small cap value fund. We also have, or I should say this 20% is in a short-term treasury bond fund. I used these ticker symbols because these were the oldest ones that gave the longest data series. And then we have the golden ratio portfolio over here, which is 21% small cap value and 21% large cap growth. It's a simplified version of it. And we have 26% in long-term treasury bonds, 16% in gold, 10% in a REIT fund, that's VGSIX. All these are Vanguard funds, and 6% in that short-term treasury bond fund. And we are running this month to month. We analyze these portfolios, and you see them all built out there. So you can see exactly what's in each one of them. And then you can see how they perform comparatively. And the 60-40 is the blue one, the Golden Butterfly is the red one, and the golden ratio is the orange one. So you can see that both of the risk parity style portfolios did much better in performance here by all metrics, really. And you can compare them here as well. You see what the final balances are. The golden ratio is much larger than the other two, but the Golden Butterfly is better than the 60-40, and it's more conservative. You see it's got a lower standard deviation than the 60-40. It's got a worst year of only minus 7.212%. That's very good. Its maximum drawdown is about half of the traditional 60-40. The golden ratio is a bit more aggressive, so it has a better compounded annual growth rate. It does have a bigger drawdown than the Golden Butterfly in both places here. And then you get to these Sharpe ratios, and you can see that the Sharpe ratio for the 60-40 for this period is only 0.63, and so both of these two risk parity style portfolios are much better. Similarly with the Sortino ratio, you can see the 0.92 versus 1.25 and 1.23. And there are the annual returns. You can see that where the 60-40 really struggled is in 2008, while these other portfolios did all right. And that also occurred back here in the early 2000s, where the 60-40 was having negative years, while these other two portfolios were actually having positive years. And we'll take a look at some of these other metrics then. Looking at the rolling returns, we see that the traditional 60-40 had a tougher time here. It did have a 5-year period where it was underwater, whereas these risk parity style portfolios never had more than 3 years, or not even 3 years, where they were underwater, and only really had an occasional bad year that they recovered from very quickly. And there is a graphical representation of that. Now if we go up to, let's take a look at this drawdowns, and you can see how bad the drawdowns were for the 60-40 portfolio compared to these other two risk parity style portfolios. And that's a nice graphical representation of that. And it shows you where the maximum drawdowns occurred and what was going on. The Russian debt default in 1998 was one of them. You can see that the traditional 60-40 and golden ratio were down about the same amount, the Golden Butterfly being much less. .com crash, the traditional 60-40 did very poorly then compared to the other two portfolios. The crisis in 2008 was the worst one for all three of them. And then if we look at March 2020, that was also much worse for the 60/40 portfolio, which was about double the golden butterfly in terms of a drawdown, and about 50% more than the golden ratio. And then we'll go over here and take a look at some metrics. And we go down here and you can see the comparisons. And what I like to look at just on a relative basis is the safe withdrawal rate and perpetual withdrawal rate. That really these two risk parity style portfolios can withstand much larger drawdowns than this kind of traditional 60/40 portfolio. And you can get a nice feel for that as to how much better they are in that metric by looking at those two metrics there, the safe withdrawal rate and perpetual withdrawal rate. And now one fun thing also to do is actually do some withdrawal scenarios. We're going to withdraw the fixed amount per 4% rule. Ways of doing this where you increase the amount by the inflation rate every time. And so that's an example of the 4% rule for these three portfolios. And you can see they all survived, but that the traditional 60/40 portfolio really is struggling, that its final balance is 18,000 compared with 25 for the golden butterfly and 34 for the golden ratio. So when you're drawing down on these things, you can see how much better than the risk parity style portfolios are. And now let's go up and test them even more stringently. And this would be a 5% safe withdrawal rate. We'll run that. And you can see that the traditional 60/40 portfolio is barely surviving, that it is only at 10,198 at the end of the period. It went down as low as 6,700, so it lost 30% of its value. Meanwhile, these risk parity style portfolios continued to grow, even taking out at that higher rate. And so again, you can see that's a much better performance for a drawdown portfolio. And now if we want to extend it out even more, let's go to 6%. If you were withdrawing from this at a 6% rate, adjusted for inflation over time. And here you do see the traditional 60/40 actually it failed, or it's in the process of failing, that it's not going to survive. The golden butterfly is surviving, and the only one that's actually above water with this is the golden ratio. But this gives you a very good idea when you're thinking about portfolios and comparing portfolios, that allows you to swap in and out of various assets to make these comparisons. One thing I do caution you in using this is that if you don't have much data for an analysis, it's not going to be very telling, if you will. And one of the drawbacks to this particular analyzer is it doesn't have a lot of data that goes back to the 1970s, which was really the worst period for most stock bond type portfolios. You get more of that in the asset class analyzer, goes back further. But you should just be aware of that whenever you're analyzing portfolios in this, that it does have limitations, and oftentimes will make things look a bit more favorable than they actually are over the many decades, particularly if you're only analyzing, say, from 2010 until now. But hopefully this is helpful to you. I'm trying to make these things not so long and complicated. But if you are going to retire, you do want to know what your portfolio has done in the past in as many different ways as possible. And this is one of those backtesters that you ought to employ before setting off on retirement. You can also use this to test out portfolios suggested to you by other people. Perhaps your financial advisor has something they want to suggest or have suggested to you. It's always interesting to see whether those portfolios that they tell you are diversified are actually diversified, because that will come out. The proof will be in the pudding as to what those safe withdrawal rates are. But I think that is enough for this tutorial. I hope you enjoy it and that I will be able to make some more in the future.